I recall we identified something like 40 possible, acquirers, right? And given that we were in the life sciences domain, analytics domain, I mean that 40 is the reasonable number. And then they ran the sort of teaser, right? And I remember vaguely that it was something like about 12, 13 companies who were interested post teaser, right? Where then we sent then they sent the NDA on our behalf, signed the NDAs, and then shared the information memorandum. So information memorandum was seen by 12, 13 out of a pool of 40, and then they shortlisted that to maybe 5 odd companies that wanted to get into a more serious deep dive. So the whole process, running this process, putting timelines to possible acquirers, because everybody wants to take their own time, and you don't have that time because you are also wanting to run a process. And then if you're putting one against the other, you want to make sure that another person says, oh, I'll get back to you after 2 months, and one person is getting back to you with an offer next week. Now what do? How will you compare? You have to wait then 2 months to the next offer. You just can't. You have to tell them, listen, we have 10 days of time. You put in an offer, either you are in or you're not in, right? So that can be best told by a third party, because you're always a bit nervous. You were selling your first company, or you're talking to somebody in the transaction team or the M&A team of a large company. Do you tell that with that kind of confidence? But when the other guy is running the process, he's going to just run it and say, listen guys, this is the way we are running the process, this is the structure, this is the thing. Come on, it's either you're there or you're not there, right? So there's no emotion in that. There's no emotion, and I think that makes it so much easier, particularly I think for first time entrepreneurs. Getting the right kind of professional support is something that I would absolutely advise.
Dear listeners, this is your host Siddharth Aluwalia, founder of 100x Entrepreneur Podcast, along with my wife Nancy. Before we begin, I would like to thank our sponsors, Prime Venture Partners. Prime is the first institutional investor in category-creating tech startups like MyGate, Neo, Dozy, Planet Spark. Prime is now investing out of its fourth fund, which is more than $100 million. Today, I have with me Amit Somani, Managing Partner, Prime Ventures. Amit, would like to know how you evaluate founders and what are the different evaluation criteria like?
Siddharth, so at Prime, we look for what we call category creating or category defining startups. So we're really looking for in what way is a startup 10x better, 1,000% better than the current state of the art. It could be product, it could be technology, it could be go-to-market, it could be a business model, whatever. So that is one core criterion. As for the founders themselves, we're really looking for founders that have very high learning agility or a very high learning quotient. Why that is important, Siddharth, is as you're going through your seed to pre-Series A to Series A and sort of journey to build your company, to get product market fit, to accelerate it, you have to make a lot of trade-offs and a lot of decisions. So we're really looking for founders that have very high learning agility.
Thank you, Amit. So listeners, let's dive straight into this week's podcast.
Today, I have with me Rohit Anand, founder of 1DigitalStack, which is an e-com analytics company serving in many countries and is having the top e-commerce enterprises and brands as its customer. Rohit is a serial entrepreneur, a very dear friend of mine. I have known Rohit since the last 5 years, and the relationship has grown tremendously. He's an entrepreneur who has supported tremendous other entrepreneurs. And today, I'm very glad to share his journey right from the point of failures he faced in 1999 as an entrepreneur, the way he restarted back again after 10 years. And today, how is the ecosystem shaping up? Rohit, welcome to the 100x Entrepreneur Podcast.
Hey, thanks a lot, Siddharth. I'm delighted to be here and honored. You rightly mentioned that our relationship has grown, and I have really enjoyed the relationship as well. As a founder, as an investor, there are so many touch points with you. And thanks a lot for your confidence in me and also your confidence in 1DigitalStack. That always means a lot to me and a lot to the team.
No, Rohit, I'm really grateful that 100x Entrepreneur Fund could be part of One Digital Stack's journey. And I want to share today with entrepreneurs a very different kind of, uh, entrepreneurial path. It's not straight to unicorn, but it's a very meaningful path. And as we, discussed, that not every path needs to become a rocket ship. There are paths in entrepreneurial journey which can give immense satisfaction, immense credibility in the ecosystem, and the entrepreneur has the right to choose what kind of life he wants to build. He doesn't need to be in a rush to prove to his team, his family, even himself or his investors that the unicorn is the final outcome. So Rohit would love to start, going 2 decades back, right? Uh, what made you start your first entrepreneurial venture in 1999? And if you can also share, your family background, your upbringing, and what made you, come to a point in 1999 that you finally took the plunge of entrepreneurship.
Hey, thanks, Siddharth, for going all the way back. In my case, we can talk about decades because, unlike many of the unlike many of the entrepreneurs who are in their 20s, I'm going to be 52 this year. So, I'm in my 50s. So you can actually go back 20 years, right now. Yeah, I was born in Delhi. Grew up in Delhi and did my schooling and college here. I helped my mom in early days, do something, do her own business, and so it was always something that was around the house, right? Sort of, Of course, in those days we never talked about scale or size, and it was a one person show. But it was always these kind of experiences. I think in early days of one's life do stay with you, and you're right. They help you to kind of get that business muscle or some kind of business thinking, right? Um, and That was always there. And even when I went to IMT in 91 to 93, I had the idea that, at some point of time I will, do something on my own. But that time wasn't the right time for me to, get out and do something right after the MBA. Those weren't the days as well. And I decided to go for a corporate job with Ranbaxy. I was a campus placement in 93. And but a few years later, it was 99, and I decided to take the plunge, put in my savings of around 20-25 lakhs. That was a huge amount in those days. And start something which was a women's community portal. The whole revenue model was built on advertising and things like that, very similar to Momsco or Shiros or some of the portals that are there, but much ahead of its time. This was Internet 1.0, and I started this in 99. And 1.5 years into it, kind of realized that the revenues didn't happen the way it was planned. In 2000, there was, if you remember, the dot-com crash as well, the first one. And suddenly the funding dried up and it was difficult to get to. And in those days, of course, the funding environment was also very different. And, there was no option but to close, right? And recalibrate my life. But so that was my journey. There were a lot of learnings from that experience. I also decided to recast my life. Decided that I was still young enough. I was not that old. I was 30. I had some years of experience in working in a large corporate. And I took this failure well, and I applied to INSEAD. Went and did an MBA in France in Fontainebleau. Post MBA, got a job with pharma because I had worked previously with Ranbaxy in pharma, with Amgen. It was in Switzerland, beautiful country, idyllic, absolutely. Then went on to Sanofi in Paris, again a phenomenal location, great place, large corporate, etc., etc. But then 7-8 years later, that bug always remained with me. That unfinished story that always remained with me, and I decided to take the plunge again and do a U-turn, sort of, and then come back to India. And I started my entrepreneurial journey, part two, with Value Edge in 2008.
And if you can share the first couple of years of value edge, how did you identify the problem, what you want to solve? How did you get to reach out to those customers? Because I remember those customers were not Indian customers; they were European pharmacies that you brought in. And how did you scale value edge till the point of exit?
Yeah, it was when I came back, I wanted to do something, and there were also some forks in the road. Right, I could have done two or three very different things. There was an idea of building a business related to IP, because part of my family, extended family, is in IP, in the IP domain. Something could also be in the in the education space, as you know, I was an INSEAD alum, and so on. But I really went after pharma because I think it's important to go after a space. It could be a niche space, but I think it's important to go after a space where you have some natural advantage, right? And that, I think, is incredibly important in any business, in any opportunity. So that's how I thought of pharma analytics as a space. And I decided to take the plunge. And sometimes you just have to take the plunge and tell yourself that if it doesn't work, you can go back to a job. Maybe it would be difficult to go back to Europe, but you can always go back to a job, and at least give yourself a year and a half to do this properly. um, for me, it was really very simple. I had worked in Europe. I had built some, I wouldn't say reputation, but at least I had some goodwill and some good relationships in Europe, where I worked with my employers and with former colleagues, and so on. And I decided to take a flight to Switzerland and just go out there and talk. And then, there's also, I think, somewhere destiny, somewhere luck as well. My previous employer, Amgen, was looking for some competitive intelligence and in the biosimilar space and so on. And they gave the first assignment, and earning in Swiss francs is earning in Swiss francs, right? So that's how the company started. And, sometimes you just have to go out there and do it. You don't need a business plan. You don't need to, formal org structure and this and that, etc. I just had a handful of people. I sat in a friend's office. There weren't shared offices, any of that those days. And I just got going. And I think one of the things that's always important is to have that bias for action, right? And do it rather than just talk about it. And then it just happened. And it was the journey of Value Edge was like, you know 8 heads in a row, right? I mean, you toss a coin and you get 8 heads in a row. It was something like that, right? And I went sometime to Europe, and then a former boss said, okay, he was ex Roche, and he said, talk to so and so in Roche. I went to Roche. They were saying, why should we outsource? We do everything in house, right? There is no need for us to outsource. And then they had some financial debacle, and then CFO changed their vision, their thought process changed internally. They said, oh, we met up with you. Why don't you pitch for this RFP? They gave us one RFP. We grabbed it. I know later that TCS and other companies were also offered the same RFP. I mean, they went to 8 Indian vendors, but we know the kind of energy and intensity that we put into that RFP. And when they saw what we had sent as a reply, they said, who are you? Why don't you come over to Switzerland and discuss with us? Long story short, in the short journey of Value Edge of 7-8 years, Roche became a $2 million business, and in a company which eventually had a business size of around $6.5-7 million. And this was our game changer. So it was destiny, but it was also about getting really high quality people in the company. I always believe in that none of, I mean, these are all knowledge businesses, and a knowledge based business can only be built by having the best of people. And that's something that I've always aspired to do, to get. So I got in two great co-founders who were highly skilled. One of them was IIT Kharagpur, Novartis. The other was IIT Kanpur. Building that team meant that there was excellence, there was consistency in our delivery, and clients just depended on us. And the whole reputation grew a lot internally, and we were able to mine our clients deep. And And then, of course, one thing led to another, and the business really grew.
So ValueEdge was a analytics business giving competitive intelligence to pharma companies.
Competitive intelligence, forecasting, data analytics. It was a mixed bag between all of those. We also set up a small technology team. We built a small cloud-based intelligence product as well. Um, at the time of exit, we had couple of $1 million plus clients. There was Roche, there was Merck, there was Bayer, blue chip clients. Um, and it was about 150 people team with offices in the US, in Europe, in Frankfurt, and in Switzerland. So it was substantial. A lot of things had been accomplished, all bootstrapped. I had a dominant share in the company, but it was also a reasonably generous equity ESOP that was given out to attract some of the best talent. We had a fantastic campus recruiting that was happening at BITS Pilani with pharma and other good campuses. And it was a well-run company from the inside.
So at in which year you exited, and what was the ARR when you exited of the company?
We were, it was a services business largely. So it was around 6.5 million. I started the company in 2008. I had exited in 2016 via a sale to WNS. But it was while I had sold in 2016, I was required to be with them till 2019. So my full exit happened effectively in 2019.
And what was the thought process behind the exit? Was there a parallel plan that you could have built from 6.5 million? The first 6.5 million is very tough. That you could have compounded even 2x annually and reached, let's say, 30 to 40 million dollars in a few years.
You're right. I mean, there could have been, and there's always a fork in the road where you say that yes, you could have, taken the company maybe to 30 to 40 million dollars. But I think that would have also, in our mind, it was sort of clear that going more than $10 million would need a different approach, where we would need to build up a sales force in the US, a sales force in Europe. We would need to raise capital. So it would be a different type of a game. It would be a game where we would raise capital, dilute. Then when we get investors, we are also driven by their priorities, by their growth rate, by their expectations, managing all of them. Then building a sales force in Europe and the US, then growing that. The founders also, my co-founders also had been around for about 7-8 years in the journey. They were also like me and saying, okay, we haven't seen any exit. We don't really know. Everybody was getting a bit restless. They also wanted to see some money, and we thought, okay, let's explore, looking at what an exit could look like via sale, right? And then see if we get a good deal. Maybe we do this now, because the other thing is that at the end of the day, it's not only about the absolute value of a company. It's about what is your share at the end of the day at the time of exit. And sometimes even when you grow bigger, but you have multiple dilutions, you might not be having that kind of share as you had today. And so we said, look, let's explore that. But one thing we were very clear about was that if you're going to explore exit, the only way to do it is to do it well, right? Anything in life, the only thing to do it is to do it well, because you'll never know whether it was the idea or it was the execution. So we thought that, let's, if you have to do it well, I was the founder who was totally focused on the exit. Let me tell you that an exit is at least 3 times more work and effort than a fundraise, right? If you think a fundraise is, highly energetic and, takes a lot, very demanding, and I mean, an exit is at least 3 times, because you're out of that. You're in cashed out, and it's like it's as it says in Latin, right? It's the buyer's problem after that, right? So we thought the only way to do it is do it well. We went through the whole beauty contest. We saw many different possible partners who can help us out here. Eventually, we settled for Grant Thornton. We were very clear that we didn't want to go with an individual a boutique or a one-man show, we were in touch with some of those. It might have cost us less, but then, if we were talking to enterprise clients, then we knew that, there was no way that we could sort of, get that kind of parity until we were well represented, and we had to be represented by someone senior at a well-known firm. So we, took our time to finalize some partner, and we eventually went with Grant Thornton. They have a nice M&A team. And yeah, and then they ran the whole process, which was, sending a teaser and then getting interest, and then, sharing the material, and then, having, and then the whole idea was to generate as many competitive offers as possible. But one more thing, what that is important, I think, when we speak of exit, is that for us, it was, yes, the valuation was important, and obviously that's the main element. But also, it was about getting the right terms, structuring it well, also ensuring that there are no outs, right? So, if you're not paid the whole amount upfront, then obviously there is a risk that you might not get paid, or you might get partly paid, or there are some outs in some way. So we had to make sure that, from a legal perspective, the outs are minimized. There is no clawback that sometimes could happen, and things like that. So that's when we also got in a large law firm. We got Ketan, to represent us, out there in this way. So all in all, it was a lot of effort. The whole thing took 6-7 months, 8 months, I think. But yeah, by 2019, we had the exit. It was a $20 million exit with 17.5 million cash upfront, and then the balance in RSUs. And of the cash, 70% was paid on day one, and the 30% was paid over 3 years. So you had to kind of be there for 3 years, and so on.
And if you can share, the process of identifying the Grant Thornton, that among the partners, EYs of the world, how you identified them, how did you build that kind of equity with them? What are the kind of fees these M&A advisors charge, and what is the actual kind of help that they do? Do they help you identify the right set of acquirers, or do they reach out to acquirers on your behalf?
Yeah, so it's well, on the fee, it really varies, but it could be anything from, the larger the deal size, the smaller is their percentage, but it's really a success fee. All advisors take a little bit of upfront. The upfront could be, it is always negotiated, but it could be anything from 5 lakhs to 10 lakhs in today's day and age. But it's basically to show some kind of seriousness and commitment. But their real fee is always a success based fee. And in our case, it was in the range of, I think, 2.25% or something like that. Always something that has to be negotiated down, right? And EY would be something like a 3%. So there was some difference between the different firms, as I recall. And a boutique could do it at maybe 1.5% or something like that as well. Yeah, they run the whole process for you end to end. So I think first is the whole thought process in terms of building the information memorandum, building the story, putting it all together. A lot of thought and effort goes into that. That is one part of it, right? Because there's no point embarking on that until that story is not built very clearly. So they need to understand you, the team, the business, the competition, the landscape. Put it all together, right? That's one part. They do the entire reach out, obviously with our input as well. So this was we were looking at a strategic partner. So I recall we identified something like 40 possible acquirers, right? And given that we were in the life sciences domain, analytics domain, I mean that 40 is a reasonable number. And then they ran the sort of teaser, right? And I remember vaguely that it was something like about 12-13 companies who were interested post teaser, right? Where then then they sent the NDA on our behalf, signed the NDAs, and then shared the information memorandum. So information memorandum was seen by 12-13 out of a pool of 40. And then they shortlisted that to maybe 5 odd companies that wanted to get into a more serious deep dive. So the whole process, running this process, putting timelines to possible acquirers, because everybody wants to take their own time, and you don't have that time because you are also wanting to run a process. And then if you're putting one against the other, you want to make sure that another person says, oh, I'll get back to you after 2 months, and one person is getting back to you with an offer next week. Now what do? How will you compare? You will have to wait then 2 months to the next offer. You just can't. You have to tell them, listen, we have 10 days of time. You put in an offer, either you are in or you're not in, right? So that can be best told by a third party, because you're always a bit nervous. You were selling your first company, or you're talking to somebody in the transaction team or the M&A team of a large company. um, do you tell that with that kind of confidence? But when the other guy is running the process, he's going to just run it and say, listen guys, this is the way we are running the process, this is the structure, this is the thing. Come on, it's either you're there or you're not there, right? So there's no emotion in that. There's no emotion, and I think that uh, makes it so much easier, particularly I think for first time entrepreneurs. um, Getting the right kind of professional support is something that I would absolutely advise. And then there are all kinds of mistakes, because the shareholders agreement comes from them, right, from the acquirer. And when we saw the shareholders, the first draft that came from, they used Shardul Amarchand, WNS, we kind of had a heart attack, right? Because they had things like, if somebody leaves, then they'll have a clawback, and so on. They had identified key people and said, look, there are 7 8 key people in this business. If anybody leaves, I'll take this much back. Now that is like, guys, can I have a control over that? I can't. But looking at the agreement like this means that already you could see that that money will not even be your money. Firstly, you have to receive that money, then pay a tax on that money, then you get the net of that, and then imagine from the net, if someone is taking that back, that's your hard-earned money. So you need to be extremely careful in that, and it does take a lot of time, effort, and I think here having the right partners makes a lot of difference.
Also, uh, at that point, would have made a lot of stressful situation between the founding team as well, right? How to find the right price, and on a daily basis to and fro with the acquirer, with their legal team, whether this will go through or not. How did you maintain that kind of a balance through the 8 month process?
Yeah, so it's a highly stressful process, no doubt about it, right? And there is also you have a need to keep your internal co-founding team involved, informed. They also need to know what's going on. You can't play your cards just close to your chest. At the same time, you want to keep the morale of everybody up, because suddenly people are then wondering that, okay, what's going on? Suddenly, in the office you have a lot of meetings in conference rooms where possible people keep coming in. It's a small office. It's not like there are so many floors, and you can't be seen, and all of that. So you, at the same time, you have to keep the business going, right? Because if you lose sight of the business, just imagine a scenario that the deal falls through for any reason, ABC reason, right? But you left your eyes on the ball, on the business, right? And then suddenly you find that the impact starts coming on the business, because you've taken 8 months your eyes off the ball. 8 months out of a year is like 2/3 of the year gone, right? So you can't do that. So it's a hard balancing act. That's why it's you know advice is never ever do it unless you're absolutely certain about it. And it can't be just, hey, we'll just explore this for a lark. You have to kind of be really serious about it, because it's too much of effort. You have to keep paddling on both boats. You have to balance the internal operations as well as keep this going with different responsibility. You have to keep your internal core group informed, because it's in a business like this, it's also about the team. They're also buying into the team, right? And at the same time, you can't let the whole thing out that people start losing interest in the company and so on. We're still growing, we are still hiring, we are still growing clients, etc., etc.
And at that point in time, what was WNS interest to acquire the company? Like, it was a $6.5 million company, but I believe WNS at that point in time could have been what, $300 million in their
No, no, much
revenue.
more. It was they were about around 700 million or something like that, and they were not acquiring us for the revenue, right? I think they were acquiring us for the capability, in life sciences. They had a large life sciences practice with one client. They had like 700-800 people with that one client, where they had built an outsourcing capability, and it was all of the, just one client. But you can imagine massive size, 700-800 people, just one client, right? But they had somehow not been able to progress this beyond this one client. They'd been trying for a few years, and that all we learned later. This was all learned post deal, because then I was reading that life sciences unit that they'd not been able to do this, and they had tried various things, and but then they found that rather than just do this, just it's a classical make versus buy question, right? I mean, do you do this yourself? They could have, or they could have just bought. And there was, for them, it was okay. We can spend $20 million for this. We may as well buy it, because anyway, the company is generating cash and profit, right? So there's a payback. They'll earn it all back, and and also sort of positions the company slightly, as they were also trying to move away from pure BPM toward more analytics and stuff like that. And so they are done. They're not very acquisitive. They are done like 2-3 acquisitions in a bunch around the same time as us. And then after that, I think again they've stopped. They, at least to the best of my knowledge, they haven't done anymore.
And if they had to, put a number to the kind of return they made from the acquisition, would you have that kind of number?
No, I don't have the math around it, but I know that the acquisition has worked very well for them, because immediately it was reflected also in the stock price, which immediately went up when the announcement itself was made. So I think they earned the entire money back on the share price alone, right? One of the learnings that I could have, and that was again hindsight, was that maybe part of the payment could be made in cash, but part of the payment could have been made in more like a stock component, which comes upfront, right? And that allows us to also partake in that ride, right? But again, that is all hindsight now. You get
Got
wiser,
it.
right, with time.
Yes, yes. And how was the journey moving forward, right? When did you decided to start again One Digital Stack? Uh, how did you meet your co-founder in One Digital Stack? And
Yeah, so that's very interesting. I had no illusions that I'm going to do pharma. I wanted to do something, and I wanted to have a second innings. Right? It was just very obvious. Although I was a quote unquote a late bloomer, you can call it, because I never made it to the 30 under 30s or 40 under 40s or any of that. But I had started Value Edge at when I was say 38, and by around 46, 47, I was kind of done with it, or getting out of it, right? So then I was very clear that I still had it in me to do one second innings, besides also now in a small way looking at angel investing and things like that. And there were two learnings, right? One learning was that uh, I wanted to go after a big problem to solve. That was absolutely clear in my mind. And life science analytics, for all its, obviously had an advantage out there, but at the end of the day, it was a relatively niche problem. So I wanted to go after a big problem. And secondly, I wanted to use technology, and I wanted to build a product company and not a services company, because the effort and the time is the same, right? But just imagine the multiple that you get on a tech product company versus the product multiple that you get on a services company. And many good reasons for that, well known reasons for that. But if you're a owner of a services company, you get the short end of that, right? That's the reality, right? So why not try and build a product technology company? So these were two thoughts. And then, I was exploring many ideas, and I was having a lot of coffee and with lots of different possible people, and, just meeting people and so on. And I, met my co-founder, Tarun, who came from FMS, Unilever, and so on, best of breed. And he talked about e-commerce, and it immediately clicked with me, because you could see the trend line. This was very clear long before the COVID pandemic, that Amazon was taking off, marketplaces were taking off in market after market, country after country. And if there was anybody who could say that, listen, I'll use a combination of technology and data science to draw actionable insights and provide these actionable insights to brands that will help them to accelerate their growth on Amazon. Who doesn't want to, which brand doesn't want to accelerate their growth on Amazon or marketplaces? And it's increasingly a very competitive space. And as brands get on these platforms and it becomes a bigger and bigger channel, they have to do this. But in reality, doing this on their own isn't that simple, right? You need to absorb a massive amount of data at scale, use data science, have e-commerce expertise, and bring it all together at the same time. And so we thought of doing this as a third party, doing this for brands, because that is not their core competence, and building a product company doing this. And for me, that was a really exciting problem to solve, and we just went for it.
And can you share the current scale and how much time it took you to build it of One Digital Stack, and scale in terms of ARR, in terms of the top marquee clients that you have?
So we started in we formally incorporated in November of 19. We brought in our first employee on Feb of 20, and today we are a 40-person company. We have about 24 clients. 25% of the business is outside India. We're about by end April, we are looking at $1.2 million ARR. We are working with some of the most marquee clients that there are. I mean, we are very fortunate. We've been very fortunate in our journey. They include the likes of HP, Nestle, Philips, Glanbia Nutrition, Havas Media, etc., all on the enterprise side. We are slowly onboarding also and we've been working with these clients for the last 1.5 years and demonstrated considerable impact. We are just onboarding a few other marquee names, including Mars Pet Foods, Marico, and so on. And also on the D2C side, we've been working with the likes of Neiman Shoes, Pilgrim, Blue Tokai Coffee, Zinga Vita, and so on. So a number of brands. And so far, yeah, it's we started. It took us about 6-8 months to build the first prototype. Once we had the first prototype, as in the case of Value Edge, we had a game-changing moment in July, August of 2020 when HP invited us, and they looked on us to help them power what they call their e-commerce command center. And that was, I think, a real turning point for us. What we were doing in terms of extracting data from Amazon, cleaning the data, analyzing that data, and drawing actionable insights is exactly what that e-commerce command center was looking for. And it was a great fit, and that was a turning point. And I always believe that getting in an anchor client relatively early in your journey is a game changer. And we've just been lucky to get HP, a client of that stature. We started work for them in India. The impact has been such that they've taken us to Singapore, and we're doing a few countries in the Asia Pac region. We're just starting some work for them in the North American continent and in Europe, and the relationship has just grown and grown.
That's been quite an awesome journey. So, first time you didn't take any investor money. Second time, how did you decide to take investor money, and how was your thought process? Who to take it from? Because you had many
Yeah, so
options.
I think when I look back, yes, we did not take any investor money in Value Edge. It was a niche space, and the company was always profitable, and we always had sufficient to funds to grow our business from internal accruals. Obviously, that thought process is still with me, but I don't believe that, and I honestly do believe that every company does not need to take money from outside. Having said that, the two situations are not exactly analogous. We're in a vast market, right? E-commerce advertising alone is, Amazon and everybody else put together is about 300 billion, right? So it's a massive, massive market. But there are also very large, well-funded players, be it Commerce IQ or Data Weave or Take Care Metrics, or there are so many of them going after some slices of this. Not everybody is doing identical things to what we are doing, or we are doing things which they are not doing, but they are all going after some slices of this. And if you really want to build a global company, we would need to accelerate with some capital as well. We don't need a lot of capital, so we were also looking to minimize our dilution also. And we thought that raising money in the range of about $1 million would be sufficient, but not it doesn't it gets us to what our goals are. We're looking to build out a Singapore office. We're looking to build out build in a strong CXO team, build in a lot of talent, and so on. But so it does need capital that will not be in sync with our inflows. But we don't need a lot of capital, and that led to the thinking that we are well served with angel funding. And that's the route that we've taken. And of course, we're delighted that Siddharth, you and 100x are on board. And we have a few marquee angels as well, in the US, in the UK, in India, in Singapore. And we're absolutely blessed to have these angels. We're looking forward to doing the round and actually getting the money in very soon, and then just going all out after that.
So I'm really grateful, Rohit, that 100x Entrepreneur Fund could lead the round, uh, along with some of the top names, in the Indian uh, startup industry as angels, along with us. Uh, Now, moving forward, right? How do you see this journey going, right? Do you see to take it to 10 mil ARR, like slowly and steadily, or do you see that there's an opportunity to fast track it, let's say in the next 18 months to 24 months?
Yeah, in the next 18 months, Siddharth, we're looking to take this to 3 million, right? And then after that, we do want to fast track it, right? So, and there are multiple growth drivers. We see the growth drivers as essentially what we are doing is, if you really think about it, we are extracting data from Amazon and marketplaces. We are analyzing the data through data science, and then uh, but it's not only about actionable insights. We also have another product that we have launched recently in the media optimization and automation space, which essentially rests on the same data, but it also combines with first party data that Amazon provides to the brand owners. And we think that that the second product that we launched, Revenity, which is a far bigger opportunity than the media intelligence, than the intelligence and insights product, RevStack. And we are seeing some rapid adoption, not only with among D2Cs, but we are seeing rapid adoption even among enterprise clients. So let me give you an example. We are working with Philips, and we were providing them with actionable insights through RevStack. But when we launched Revenity in January, they are very keen on it, and we've signed a contract with them to help them in optimization as well. So even as enterprise clients want optimization, because everybody needs to be efficient with their Amazon spend. Also, mid-market clients and D2C clients frankly told us that we don't have a need, we don't even have the internal capability to absorb these insights and make sense of them, because we don't have the analytical horsepower, right? All we need is someone to actually run the campaign for us in an efficient manner. So we think the opportunity is far bigger with Revenity, which is our media optimization product that we launched in January. So I think the acceleration will be far more rapid from now on. What we need to get right, and that is something that is very much a work in progress, and we have not solved. And it's not that, and I never say that we've solved everything, right? Is to get our GTM absolutely right. Uh, we think that this also will be, I mean, while India has been a big base, but we think that a massive opportunity exists in Singapore and the APAC region. Tarun, my co-founder, is planning to relocate to Singapore in the second half of the year. We think that the relocation will sort of give a massive impetus to this, because then he's physically out there, and nothing like having the founder in the market. We've seen that in startup after startup. Right. We're also looking to bring on a serious head of growth, to bring on marketing, etc. A lot of learnings from other, SaaS companies, that sales and marketing has to be front loaded as opposed to coming in late, right? So I think that's something consistent. I saw that in Shashank's podcast as well. I think a lot of people talk about that. So I think that's something that I want to also do. Right. So if we get all these pieces right, I think there can be a massive acceleration. There is no need for us to be slow and steady. This is, horses for courses. So this is not value edge. This is a company that can grow much, much more quickly, a much larger TAM, a much larger opportunity out there. But it's still for ours to get to it, right? We still have to execute it, and there's just a long way to go.
And what's your vision and ambition for One Digital Stack? Like, where do you want to take it, and why do you want to take it? Definitely.
Yeah, Tarun and I, when we sat down and we talked about our vision right on the early days, we were both clear that we want to build a large company, right? I mean, there is a little joy. It's not just the financial outcome or anything like that, but there's a joy in building a large company that impacts a lot of clients, a lot of brands, a lot of people, right? And we really wanted to do that. So that was like the founders, having their original coffees and meeting up on the Starbuckses, and then doing some whiteboarding together, and then figuring it out that okay, this is a problem that we really want to, because when you go after a problem, you are going to devote 10 years of your life to it. So you need to keep that 10-year, right? So you cannot go after something and then just say after 1 year, oh no, now I've changed my mind, now I want to go. Yes, there can be tweaks within that, but then broadly you are going after that for a substantial part of your life, right? So we were very clear about that, and we thought we'll do whatever it takes. Now, in terms of, yes, it's important to have very clear financial outcomes, also very clear and as we talk to investors also, we need to be clear about where do we really want to take this, and how big do we want to make this. Yes, we have that coveted $100 million kind of a milestone in our mind, that we will eventually get to that milestone. We want to be a large, well-known, well-recognized player in the e-commerce enablement ecosystem, right? More broadly, right? I mean, as e-commerce grows into thousands of billions of dollars, because that's that's where e-commerce is today, and right, the enablement system, one part of it is the logistics enablement or the warehousing enablement, or other types of enablement. But then there'll also be the data enablers, the IP enablers, the data science guys, right? All of the enablers will also have substantial businesses, right? And we want to build a substantial business in that ecosystem.
And for you, the holy grail is 100 mil ARR company this time. That's what you want to
Yeah, I
do.
mean, that's something that we have set ourselves to, right? Right, and at this point in time, I think we have got a good early momentum into growing that. What does that mean? Actually, if you think back about it, that how many brands would that take? At our current AOV, it would take us about 3,000 brands, right? But that's a very, very rough number, because we can also talk about other products. We've got one product that we've got is this whole brand watch, which could talk about IP, and brand reputation, and again, that watching that on behalf of brands on e-commerce channels. We're talking about trends, which could be another product, and so on. So the if you have more products, etc., the number of brands could come down, but we could be talking about impacting anything from, let's say, 1,000 brand upward, right? Which is a very, very different business to what Value Edge was, the kind of impact there was. And I'm very confident that if we get the team right, because I'm again going back to the basics, right? It's about team. 50% is about team. I mean, I'm just completely overweighted on team. We've got the space, we've got the product, we've built it. Clients wouldn't be paying us for it. We wouldn't have won an RFP with Havas, or we wouldn't have HP giving us more work, etc., if we weren't already solving something for them. So they are paying us, we are solving something for them. But what we really need to do is now, just get out there. We've got the 0 to 1 journey, right? If we get the team right, and we are able to execute along our plans, there's no reason why we can't do it.
And this time around, what is the same thing that you are copying from Value Edge, and what are the things that you are doing completely different from Value Edge based on your learnings?
Yeah, I think what has really been important in value edge is getting the right quality of talent, right? So we have, for example, someone in our company, Shantanu. He's IIT Delhi, ISB. Worked in Innovator and some other companies, etc. So very strong pedigree. He's heading operations. We're looking at getting someone else at head of product, again very strong, ISB, this and this, and she's about to join us, at the moment. Um, Same thing, we are talking to some other highly pedigreed people, ex IIT, etc., etc., to come in as head of growth or head of data science and so on. Building that CXO team at that level, being generous with ESOP, so that wealth creation can be shared as opposed to wealth creation being concentrated, creating a culture of fairness, meritocracy as far as possible. I'm never, it can never be perfect, but it's not that there is politics or there is time for politics, or there is favoritism, or so and so is getting a promotion, or so and so is being is boss's favorite, and none of all that stuff. We don't have time for all that stuff. So that's something that we did very well at Value Edge. I would love to retain that, and trying to retain that. We were also very strong on things like employee benefits and health insurance, other plans, etc. Of course, things have changed. The providers today have different. I mean, you get aggregators who've aggregated yoga and meditation and gym and everything all into one, and those are the kind of tweaks. Of course, time has passed, and you get these kinds of things today, right? That you won't get. You get new different kind of office spaces which weren't there, etc. But broadly, this thought process of people first, team first, and then everything else falling in place is the philosophy that I think made Value Edge successful, and that's what we want to continue. What is different? I think what is really different is, if you see, the whole business model itself is different. We are genuinely a technology company. Yes, there may be some service element on top of it, because particularly as we work with enterprise clients, they may need some analytical support or some analyst time to be built on top of it. But genuinely, to build a very strong technology rich company with solid analytical capability, I think that is very different, right? And I think that was something that was missing, that could enable us to scale up, right? The other thing that I think was very different was, which again I planted as in the roots of the company, were that uh, there is a genuine co-founding relationship. Tarun and I are equal co-founders, and I think that also is very foundational. And I really, that was again something very thoughtfully done. It wasn't because I wanted to bring on someone who's better than myself, smarter than myself, and and then it sort of, there is no so that we're always on the same side of the fence, right? You need there's no time, energy for interpersonal conflict, or anything like that, right? So we always see it from one perspective, because we are completely aligned as we are equal owners, right? And I think that is very foundational, and I did not have that equity structure with my co-founders last time, right? Which then results in downstream, when things are going well also, and there's some time, then you kind of think, oh well, I'm just a small owner, maybe I can go out and get something better for myself, or maybe I can set up my own thing or whatever, right? That doesn't happen if you are an equal owner. And I think that was something that I had also learned and brought in out here.
And Raj, you have been fairly involved in the startup ecosystem in the last 3 years. Can you share about your set of angel investments or the funds that you have invested in? And what's your structure of thinking? How do you invest?
Yeah, so well, thanks for that, Siddharth. I mean, it's a mixture of things. One is that, let me tell you that I'm very conservative first and foremost, because I think that's extremely important. I wanted to, when I had a pie to invest, I wanted to firstly get in a professional firm to help me in that. So I brought in IIFL to help me in that. So I want to be absolutely clear about that, and I think that's extremely important, because I think people, it's not necessary that if you're a founder, you would also be very good at managing money, right? So that's one thing. And so 90% of the money is in various equity funds or debt funds, etc., etc. It's the 10% which is, where I am also LP in some funds, and I'm also an angel investor. So that 10% is also then further split between LP and an angel investor. Now, being an LP allows me to then participate in the thesis, in the investment thesis that the fund itself is running, and different funds have different thesis. I am largely weighted towards tech, right? So that, I am an angel investor in, for example, Your Nest Fund 2, Your Nest Fund 3, Pi Ventures, right? A mixed fund like Stellaris, Fund 2, which is between consumer and tech, right? The only large consumer fund where I'm an LP is Six Sense, and has shown some incredible success on the consumer side, right? So, but I'm largely weighted on the tech side, But yes, so so I'm an LP, and so approximately 40-50% of the my corpus on this side is already invested as an LP, and the balance, part of it has been invested, part of it is left, which is purely my judgment, good or bad or ugly, we'll see now, because all these things take time. But yeah, very proud to be associated with some good investments, made investments in Neiman Shoes, where you advised me many years back, so I'll never forget that. Virohan on the health tech side, Pluto Kai Coffee, Biryani Blues, Viziki, and several others, Navia Healthcare, etc. I'm guided by two things out here, right? And I've tried to keep this very, very simple. One, I'm guided by the market that the entrepreneur or the team is pursuing. How large is this opportunity? Is it a niche opportunity? Do they have any competitive edge in this opportunity? What is their right to win out here, right? So what is the opportunity, and really trying to understand the opportunity. And the second thing is really the quality of the entrepreneur and the founding team. I mean, I often judge that, are they better than me, right? And or me at that age, right? And I'm just surprised by and delighted by the quality of entrepreneurs that are coming out now. I think they're a notch above what they used to be. Not a notch above, I think couple of notches above. Incredibly smart, very well read, very well informed. They So I think that, if you sort of combine both these, unless things can go wrong, I mean, execution can go wrong, the whole market can change, many things can happen, the journey is never a straight line, it can be rough and rocky. But if you have the right crew, and you're backing the crew, and they have gone after broadly the right space, then yes, hopefully hopefully many of them will sail through.
Thank you so much, Rohit. It's been incredible walking in your shoes through this podcast. I hope listeners enjoy it, cherish it as much as I did. And there are some final points that, we never had in our conversations during the last 5 years, which I got to learn through this conversation.
Hey, thanks a lot, Siddharth. Thanks a lot for having me. I know we've been wanting to do this for a while, but I'm really honored and delighted to be here. Yeah, and again, wish you all the success with 100x, and I'm delighted to be part of that as well. So, let's let the journey go, and let our relationship bloom. And I look forward to more informal interactions as well.